Welcome back to EDS, and in this video we're going to take a look at how you can write your own options contracts, collect a premium upfront and generate consistent returns year on year. So the first thing we want to do is pull up any equities underlying in your brokerage platform, and you also want to then navigate to a list of expirations for that underlying. Any equities underlying will do. The purpose of this step is simply just to lock in an expiration date that we can use to mock up our positions, and we can use to filter out certain things on our watch list. So the expiration date that we select needs to be a monthly expiration and not a weekly or quarterly. And it also needs to be between 30 and 60 days out in time. So there's two expiration dates that currently fit that criteria: December 20th and January 17th. So either one of these would be fine. I would personally lean towards January 17th. 31 days is a bit short for my liking. Personally, I typically like to be out of positions um, around about with 21 with about 21 days left on there. So 31 days only gives about 10, maybe 15 days max if you were to push it to 15 days to expiration. So January 17th just gives us a lot more breathing room. So January 17th, 59 days out in time, we can use that information on our watch list. We can come over here and simply filter out any underlying that has earnings over the next 59 days. And the reason for this is because earnings will increase volatility, and it will almost certainly mess up our deltas. So both of these things will have a negative effect on our P&L. So we want to rule those out. And then below, we can also filter out anything with a low liquidity rating level. This is just so that we ensure we're only trading underlyings that are nice and liquid, easy to get in and out of, and it also ensures that we'll only be paying tight spreads, not wide spreads. So we'll be left with something that looks like this. This is just a pre-made watch list. You can use any watch list you like. You can make your own. I personally like to order everything from high to low IVR. Um, we want to be selling when volatility is high, and then or shorting when volatility is high, and then buy back after a bit of a contraction has played out. That's the game plan. It doesn't happen every time, but most of the time that's typically how it works. Because volatility is mean reverting. So I like to just order it from high to low. Anything above 50, an IV rank of above 50 can be considered high. Sometimes an IV rank above 30 can be considered high. It just depends. Um, and at this point, we just go down the list and we just see what would fit well inside our portfolio. Just keep in mind what's already in your portfolio and make sure everything is nice and diverse. Make sure that you're not too heavy in any one sector. And we can just go down the list. And just one thing that really sticks out to me right now is TSM, but we had a look at TSM yesterday. BA was looking quite nice. QCOM, I think we'll go with um, BA. BA's been doing some interesting stuff recently. GLD also looks good. You want to keep in mind the IV rank, the size of the underlying, and also the absolute IV level. So, for example, GLD has a higher IV rank than BA. However, BA has a higher absolute IV level compared to GLD. Um, so if we just go back onto our watch list, so it's got 17% there, and BA is currently at 38.1%. So if we go into BA, we already know we're going to be at January 17th expiration, and at this point, this is the options chain. We simply just want to sell one call and one put. And we want to sell them between 15 and 20 deltas. So if you go on the call side, we've got 17 delta here at the 170 strike. And then on the put side, we've got a 14 delta and also a 20 delta. Um, Either one of these would be absolutely fine, whichever one you wanted to pick. I'm personally just going to be slightly aggressive and go with the 20 delta. We can also be slightly aggressive and go with the 22 delta at the 165 strike. So we've got between 130, we've got a range between 130 and 165 currently. So what this is going to do is it's going to give us a very high probability of success. We've got a probability of profit here of 68%, and we've got an 83% chance of hitting max profit. 50% of max profit over the next 59 days. So very, very high probabilities of success. We would collect $524 upfront in premium, and our broker is only going to require a little under 1.5k. So this is a very, very nice and high return on capital trade for a naked position. If this amount of buying power was too high for your portfolio, you could simply just buy another contract a little bit further out. This is going to reduce the buying power requirement. It's also going to reduce the premium. It's going to reduce your probabilities of success, but generally speaking, you get a higher return on capital by doing this. And if you want to know how much buying power you should be allocating to any given position, we've got a position sizing template here that's free for everybody to use and get a copy of. Link is in the description. The way it works is you enter in the size of your portfolio at the top, and then below you enter in what the current VIX level is. And then everything will then be automatically calculated for you there on out. As long as you follow everything here, over the long term, you will be absolutely fine. You won't run into any problems in your portfolio. Again, link for that is in the description. Just head on over to the free position sizing template. If you want to learn in more detail, click on EDS Premium. Get yourself signed up. Inside, you'll have access to our portfolios that will allow you to see the positions that we're placing, how we're managing risk, how we're making adjustments, all in real time. There's also a full course, so no prior knowledge is required. We will teach you everything you need to know. It is a private community, so if you get stuck, you can speak with other like-minded individuals or with myself directly. There's a 100% money back guarantee. So once you have studied our full course and followed our trades for at least 6 months, if at that point you haven't been profitable, then we will work with you for free until you are, or you can simply request a full refund. So it's completely risk-free on your part. Right now, it is £1 a month to sign up. The price will be increasing. However, once you're in, the price is locked in for you. So you are rewarded for getting in early. And with that being said, I will see you guys on the inside.